All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Moriarty, and today we're going to be taking a look at ticker WBA, Walgreens-Boots Alliance. Just give me 1 second. Check a few settings, make sure everything's working correctly. Okay. Good. So, pretty excited to get to this valuation today. It's been a few weeks since we've actually did a proper valuation. We've been just screening through stocks, looking for best options of things to value. I've been taking recommendations of stocks to look at, and this particular one was one of the ones that people were asking for. I'm definitely trying to do a few of those in the near future, mixed with ones that were especially appealing to me, but we're definitely making it through the list. I don't actually have the list in front of me here. This is just our normal watch list. But in other news, I did want to also note that the spinoff of Warner Brothers Media onto Discovery from AT&T did actually go through today. It's not entirely complete because it's a little bit of a multi-part process, but it's going to make those things to go through. But I know a decent amount of people have watched those videos on my channel or came to my channel through them and have probably been wondering about my thoughts on that, especially with the volatility. And anybody that's looking at it would know that AT&T is down close to 20% today. It did go down even more and then went back up pretty significantly through the course of the day. But if you were holding the stock through that, you probably are not down 20% on your combined position between the two companies, because for example, I lost about 4 to 5% on that AT&T position, but with the WBD added to my overall portfolio, it actually made me net up about 1.5%. So there's no saying where it's going to go from here. All my valuations were based off of where I thought both of those stocks would be 5 years from now, so that is worth noting. But as of right now, you could, if you had entered into AT&T the day before it was required to be in for those shares, and then sold in whatever period of time it is that we can sell our WBD shares, because that may not be for another week or two until the Discovery end of the deal closes. But if both stocks are at the price they are today, then you would on net be about 1.5% upward. So I would argue that essentially no downward movement happened today in the combined holding of AT&T and Warner Brothers Discovery. You are actually up today. And that is a repricing of AT&T's shares based off of the current expectations around the dividend. That does bring the dividend to about a 5.5% split, but I do believe that it's going to move up to a fair value of about $23.68. That's my current fair value for the stock. So I do have a projected return of 16% currently on where it is, which is not terribly far different from what it was if you had subtracted out the WBD. And I actually think that the catalyst of having removed the company or the assets from the company as well as the debt is only going to bring an opportunity for that real value to show up. The Discovery part of the value, I'm a little bit more concerned about. I definitely think that that's a very debt-laden spinoff, but it does also have a huge amount of revenues and a pretty decent platform that, while it's been slow to pick up steam in the streaming efforts, the combined properties between them, I think, put them in a decent position to maybe compete a little bit better. So while I do think this one has a little bit of a hard time trying to reach its fair value relative to AT&T, and I'm also less attached to the company, I might be spinning off some of those shares, or selling them, spinning off being a funny word there. I might be selling these shares a little bit more immediately than AT&T's, depending on how things go. As it currently stands, I'm not making any major moves in that. I might just trim both positions once it's available to do so, because I did actually up my exposure to AT&T pretty significantly before this deal went through, because I had pretty high confidence in the numbers that I had put together. And that's part of the reason I'm saying, well, I'm pretty proud of the decision as of today, because I'm up on net about 1.25–1.5% overall. So the fact that I made a huge exposure, changed AT&T right before the deal, pretty sweet. But that does mean that I need to trim both positions back down because they're much too large of a position relative to my portfolio. But I won't be exiting either position until at least I've gotten maybe a quarter or two out of them to look at the numbers a little bit more specifically, or at least that's the case with Discovery. AT&T I don't have major positions on. But anyway, Walgreens we will be getting into now. I did do the usual prep work that I do before most of my valuations. I listed out all of the debt that they have, including lease liabilities, which is a pretty interesting thing about walgreens-boots. They have $34.3 billion in debt if you include their lease liabilities, but about 25.4% of that, or 25.4 billion of that, is in fact their leases. So it's mostly leases for them as far as debt goes, but they, that is what it is. It's debt. It's not really that big of a difference. Weighted average interest rate of 4.49% and weighted average maturity of 10 years. So not terrible terms of debt at all. Not amazing terms either, but not terrible. And then I do have the 1 year's worth of numbers already placed in, as well as the segmentation, which I did split off into pharmacy, retail, and wholesale. They have those split off into international US. I just combined them all together. Now, they did do a bit of a switch on the wholesale part of the business, combining it or spinning it off and doing it with a deal with one of the companies that they already have profit sharing agreements for their equity holdings in them. So they basically have consolidated the wholesale part of their business, or not consolidated, they sectioned it off to a separate business altogether and are just retaining an interest in it altogether. But I did decide to leave it in the segmentation because of the way it affects their overall earnings. So either way, I end up with an unlevered beta of 1.09, and with their leverage, that's probably going to be increased pretty significantly once we lever it up. Sales capital ratio for the industry of 5.13, which is pretty significant. It is in retail, so it's usually pretty high, but actually the healthcare support part of their business that I included is really pushing that up, so it's a little bit skewed on that part. And then the net margin is 5 to 6%, which they're actually a little bit low in that regard. So they're low in both those. The most recent year sales capital ratio had 2.35, which is still pretty high, but it's low relative to that number that I came up with, though I have low confidence in that number. And then their margin is 1 to 2%, which is low, but retailers do tend to have low margins, even if the combined number I got was 5 to 6%. So I'm going to be working on the rest of these numbers for a little bit. I will be playing the the second quarter earnings call while I work. I'm actually not going to be doing a rolling, speaking of the second quarter, a trailing 12-month number right here. I'm just going to be basing off the fiscal 2021 numbers, and then instead boosting the valuation forward using the discount rate, which is something I kind of typically already usually do. I just don't usually show it when I'm doing my valuation directly, because we're usually doing valuations immediately after the 10Ks, but I just don't feel like doing the subtracting 2 quarters from 2020 and then adding 2 quarters in kind of shenanigans. It's a big mess for a company that doesn't grow that much. Because of the fact that Walgreens doesn't grow that much, it's mostly in steady state. The valuation does not shift that much year to year, so I feel perfectly confident just doing it this way off of the 2021 numbers, and instead boosting the discount rate forward half a year, effectively speaking, and taking into account the future projections that we're going to have for that. So that's just so anyone's wondering why it is I'm only doing 2021 numbers and back, and even though we're listening to the second quarter earnings call, that is the reason why. So like that. And if you're watching at this point and you enjoy the content like this, please go ahead and give us a like. It would be really, really appreciated, as well as any subscriptions that if you're not already.
Good morning. My name is
Hey, what's up, GT?
Operator today. At this time, I'd like to welcome everyone.
Hey, Avadoris, welcome aboard.
Second quarter 2022 earnings conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you'd like to ask a question during this time, simply press star, then the number 1 on your telephone keypad. To withdraw your question, press star 1 again. Thank you. Tiffany Kanega, Vice President, Global Investor Relations, you may begin.
Good morning. Thank you for joining us for the Walgreens-Boots Alliance earnings call for the second quarter of fiscal year 2022. I'm Tiffany Kanega,
Very appreciated.
Vice President of Global Investor Relations. Joining me on today's call are Roz Brewer, our Chief Executive Officer, James Kehoe, our Chief Financial Officer, and John Stanley, President of Walgreens. As always, during the conference call, we anticipate making projections and forward-looking statements based on our current expectations. Our actual results could differ materially due to a number of factors, including those listed on slide 2 and those outlined in our latest Forms 10-K and 10-Q filed with the Securities and Exchange Commission. We undertake no obligation to publicly update any forward-looking statement after this presentation, whether as a result of new information, future events, changes in assumptions, or otherwise. You can find our press release and the slides referenced on this call in the Investors section of the Walgreens-Boots Alliance website. The slides in the press release also contain further information about non-GAAP financial measures that we will discuss today during this call. I will now turn the call over to Roz.
Thanks, Tiffany, and good morning, everyone. Walgreens-Boots Alliance once again delivered strong results in the second quarter. Sales increased 3.8% in constant currency, or high single digits on a core basis, excluding the negative impact of Alliance RX Walgreens and the positive M&A activity in Walgreens Health. Adjusted EPS grew 26.5%. Our good performance reflects execution across each of our business segments. Our U.S. retail sales comp of 14.7% was the highest in over 20 years, above even last quarter's record, and we are seeing significant recovery in our international markets. At the same time, we are building our next growth engine, Walgreens Health, which is on pace toward its long-term targets. And of course, we continue to serve communities with COVID testing and vaccinations to fight the pandemic. During the quarter, we also undertook important actions to advance our strategic priorities and to ensure our asset portfolio is strongly aligned. We initiated a review of the Boots business, and this process is progressing well. Looking ahead, we are maintaining our full-year adjusted EPS guidance of low single-digit growth, which we raised in January. Our outlook incorporates healthy fundamentals in our core business, as demonstrated with robust sales and earnings growth year-to-date, balanced against ongoing investments in our growth initiatives and our people. We are delivering against our
I think he was asking about NRG.
Out in October. We're moving quickly to execute our vision of consumer-centric, technology-enabled healthcare solutions, which extend well beyond the pharmacy walls. As we begin to offer a care delivery experience that improves health outcomes and lowers costs for patients, providers, and payers, we are well positioned to drive accelerated, sustainable value creation. Next, I want to take a moment to review Walgreens' initiatives to provide local communities with access to important resources during the pandemic and as we navigate the recovery into an endemic scenario. In the U.S., we administered 11.8 million COVID-19 vaccinations within the quarter and over 62 million to date. Our pharmacy team members are healthcare heroes. The majority of our patients and customers see their pharmacists more than they do any other healthcare provider, and we recognize their tireless dedication and contributions to the pandemic response. The Omicron wave in December and January also drove elevated levels of COVID testing, both in-store and at home. We completed 6.6 million in-store tests during the quarter, and over 20.
I don't really have a huge opinion per se on which one I think is stronger in a large sense. CVS is taking a little bit more of the market. I'm doing WBA mostly today just because it was the one that was coming up in our screens and people are asking about it.
Socially vulnerable and medically underserved populations.
Yeah, this definitely isn't I often don't look at stocks because I think that they are good. Sometimes it's just I'm just looking at things. We'll see what they come up with today. It could be that CVS is the better choice.
And improve mobility. Our leadership in vaccines,
but I didn't even look at CVS.
One way that we are becoming the leading partner in reimagining local healthcare and
well-being very nice.
For all. The second quarter.
What prices are they at right now?
Progress towards each of our 4 strategic priorities. Let me update you on our latest initiatives and then spend a moment on the drivers of execution at Walgreens Health. First, we are transforming and aligning the core business and building a pharmacy of the future that will enable and support our healthcare strategy.
I highly doubt it.
Momentum online in the second quarter, with digital sales up 38% in the U.S. or 116%
the operating lease.
on a 2-year stack basis. Same-day pickup orders accelerated sequentially to 3.9
Okay.
million orders. We have also enrolled over 96 million My Walgreens members, up nearly 11 million.
Well, best of luck to you in that. I've definitely looked at them many, many times.
Activating members through personalized omni-channel messaging and offers. Additionally, our alternative profit stream.
Hey man, it hurts to go through it, but it's always good if your position goes down a little bit after buying. That way you can buy more.
And is running
you know.
ahead of expectations. We continue to see digital media as a significant opportunity for us. Finally, we have 3 automated micro-fulfillment centers open and are on pace to have 22 by the end of fiscal 24.
Does Rite Aid still exist? I thought they got entirely bought out
Over time.
by Walgreens or CVS. Maybe, I thought one of them bought the other out.
Prescriptions for pharmacy served, removing routine tasks and excess inventory.
I'm pretty sure they kept some of the branded locations open, but they own them, I think.
We're building a platform of technology-enabled healthcare solutions with the consumer in mind, which is well positioned to fuel our.
No, I don't know anything about energy.
Nearly half of our store footprint will have a healthcare touchpoint between our organic Walgreens Health Corners and the co-located clinics with VillageMD. VillageMD.
Yeah, that's what I thought. I was pretty sure, because I'm pretty sure I've scanned past it before, but I've never really looked at it. So yeah, I was pretty sure it was a utility, but
for calendar year 2022.
I've definitely never looked at it closely.
On the Health Corners front, we remain on pace to have 100 sites in operation by year end. Third, we are refocusing our portfolio and optimizing capital allocation. We continue to apply a rigorous strategic lens to our equity investments and explore all options to unlock value. Recently, we have gained full ownership.
I mean, I'm waiting for Google to slip very low.
in our German wholesale JV, creating greater agility ahead. We have also announced the strategic review of our boots business.
They must have just bought a lot of them then.
Well, and we will
what is my current Google valuation, now that I'm thinking about it?
Finally, we are building a diverse.
Okay, so apparently I want Google to go below 2,000.
Our deep and experienced bench is executing our strong results today and implementing the bold steps necessary to drive growth ahead. We are making rapid progress towards building out Walgreens Health with a clear path to a
tomorrow the inflation numbers come out.
$4 billion exiting fiscal
CPI comes out tomorrow, and the day after that PPI comes out. So
$10 billion in sales
rest in peace to everybody's portfolio.
We will improve health outcomes and lower costs for payers.
Get ready for those bond rates to jump tomorrow.
Through owned and partnered assets. The goal is to support the patient journey across the entire care continuum through omni-channel solutions. This is why you see these complementary assets spanning primary care through VillageMD, specialty pharmacy through Shields, and post-acute care through our pending CareCentrix investment. The Health Corners play an important role in addressing care gaps through our health advisors. Today, Blue Shield California and Clover members can walk in and have access to clinical services like A1C testing.
I definitely think it's not going to be super pretty for several months. I mean, I'd love to be wrong, you know. I'm not hopping out of the market or anything, so you know, I'd love it to go up, but I definitely don't have a lot of optimism about the market this year.
Our health advisors are becoming trusted neighborhood sources of education, recommendations, and
what did I miss?
That can help our patients to better manage their wellness. This is a transformational process to become a leader in value-based care, as only Walgreens can do through our trusted customer relationships, local knowledge, and deep data.
I didn't look at it yesterday, but I'm familiar with the company. I used to work for a competitor of theirs, so I mean I'm familiar with the industry and like what they do. In previous times when I've looked at them in the past, I know that they've generally looked pretty expensive. But maybe they're not today.
Driving 1,000 co-located clinics across more than
what am I screwing up over here?
2027. VillageMD is in
982.
22 markets today most recently expanding to Boston, Jacksonville, and Tucson in February, Denver in January, and San Antonio in December. VillageMD's care delivery model is highly scalable, with attractive unit economics over time. Shields continues to rapidly expand its platform, representing specialty patients across more than 30 disease states, with more than 70 health system partners nationwide. In November,
Man, what am I screwing up over here? I don't know. It's hard to tell me where I think it'll bottom.
Geographic reach in the Northwest and Northeast U.S. Importantly, WBA and Shields are collaborating to identify
I think
where their
the S&P is worth 42.43 right now. So I don't even think it's that overvalued. The whole S&P. But you got to keep in mind that that includes all the big profitable big dogs on top. If you assume that maybe a 25% margin of safety on the number I gave you, then that means 31.82.
And we will initiate the next wave of 9 health corners in California.
But that's also based off of the interest rate today. So if the interest rate moves up, that number will move down. I just don't value the index off of where I think the interest rate will go, because it's very difficult to do things like that.
And remain very excited about our growth potential. We are executing across our balanced plans for fiscal 2022 as we build a strong foundation
what am I doing?
for sustainable low teens EPS growth.
Wrong here. I'm trying to figure out why this number is.
Well-being for all, with a clear path towards accelerated value creation. With that, I'll hand it over to James to provide more color on our results and our outlook.
Thank you, Roz, and good morning. We had an excellent quarter with focused execution across all of our businesses.
I don't know what's going on here. Like, what's wrong with this number? I don't.
Ahead of expectations.
I swear I'm looking at this. It's all wrong.
Up 26% versus prior year.
106.
We continue to execute strongly in COVID vaccinations and testing. Our U.S. retail comps were the highest.
Oh, wait a minute. Okay, I figured it out. I figured out what I was doing wrong. I was adding this when it needs to be subtracted. Okay, I'm like sitting here like, what the hell is wrong with this number? Jesus. This is what happens when you don't do valuation for 2 weeks, guys.
Was $1.1 billion in the quarter, with free cash flow of $669 million. And finally, we are maintaining our full.
Well, it wasn't really a problem with the spreadsheet. It was just like this right here, the equity earnings in Amherst-Bergen. I was counting it as an expense when it's an income. So there was just a negative in there. I am working on fixing my my spreadsheet template to try to make it a lot cleaner, make it look a lot better. But it's just, there's so many other things I'm trying to work on simultaneously. I have FB. I bought into it not terribly long after I valued it most recently. It's not a huge position because it but I'm up on it pretty good too, because I basically managed to average in basically to the bottom. It was really good. It's 3.7% of my portfolio.
Driven by strong gross profit performance in both pharmacy and retail in the U.S. and a continued rebound in international sales and profitability.
My average price, I think, is like 201, something like that.
In the quarter, a constant currency increase of 26%.
Yeah, I'm pretty stoked at how luckily I managed to get that. Did he? Did he really? Wow, I did not see that yet.
EPS growth by 15 percentage points.
It's getting soft in his old age. I mean, unless he knows something I don't know.
Reflecting a charge to the company's equity investments related to the impairment of minority investments, as well as lapping a $191 million gain on the partial sale of our investment in Option Care Health in the year-ago quarter. Now, let's move to the year-to-date highlights. Year-to-date sales advanced 5.7% on a constant currency basis, including a 400 basis point.
Man, that's crazy. Both him and Monish Pabrai had soft hands on Alibaba. That's crazy.
Adjusted operating
I mean, you know, I'm like down like 20% on it, so you know, I feel the pain, but
Strong adjusted gross profit growth
whatever.
across pharmacy and retail in the U.S. and a continued
I feel more optimistic about Alibaba now than I did 3 months ago, personally, about the whole ADS situation. Oh Jesus, what was I doing? Skip the fucking.
Increased by $4.54 to $5.15, reflecting a $2.5 billion after-tax gain in.
Obviously, there is the COVID pain that's happening in China, so I guess there's that perspective to take on it. But I don't look at that as damaging Alibaba. If anything, that will damage some of its potential competitors more than it. So that's just the way I see it.
Now let's move to the U.S. segment. Sales increased 1.2% in the quarter, with a strong performance from Walgreens, more than offsetting a 680 basis point headwind from a 43% sales decline in the Alliance RX specialty business. Comparable sales advanced 9.5% in the quarter.
Yeah, the official portfolio that he manages is actually pretty tiny compared to his actual net worth. It's like, it's not his wealth so much as like a job he has. You know, it's like he's hired to manage this portfolio for these other people, but it's not like the same as like Warren Buffett's relationship with Berkshire. It's like Charlie Munger's relationship with Berkshire is closer to his actual wealth than his relationship with the management of the Daily Journal portfolio. Yeah. It's really just kind of like a leftover extra job he's got, sort of, for fun.
As a result of Alliance RX.
Not that he doesn't take it seriously, of course. But
income growth of 37% was entirely due to strong gross profit performance.
But if I was his investors over there, I would definitely be wondering about cutting the Alibaba position. That's definitely pretty interesting.
Percentage point negative impact from Alliance RX. Comparable pharmacy sales were up 7.3%, while comp scripts increased 4.7%, with COVID-19 vaccinations accounting for 275 basis points of the script growth.
Yeah.
We completed 11.8 million COVID-19 vaccinations in the quarter and administered 6.6 million COVID-19 tests.
Yeah, I mean, I definitely like the fact that you guys recognize each other enough that you can kind of carry on some conversations amongst yourselves, which doesn't necessarily require me to respond. I mean, we got 6 viewers right now. That's pretty much like 6 on YouTube and 1 on Twitch. That's pretty much the most we've ever had at the same time. We've been doing really good on numbers. It's slow but steady. No, yeah, I definitely thanks for mentioning it. I didn't know that, and you know, that's very interesting to me. It doesn't affect my opinion on it at all. You know, yeah, definitely it doesn't sway me or add fear to my position or anything. I think it's him being foolish. That's pretty crazy. But yeah, that's pretty interesting.
Compared to the second quarter of 2020 pre-COVID,
hey man, just stick around.
Pump sales were up mid-teens. We saw broad growth across all.
It's a slow roll to 1,000 viewers, but we'll get there. We'll get monetization at some point.
And cough, cold, flu.
That's the dream.
Transactions were up 9.5%, and discretionary categories performed well, with personal care comp sales growing 9.7% and beauty growing 6.5%.
All right, not getting fooled by this line here again.
Strong sales growth drove low teens growth in gross profit. Turning next to the international segment, and as always, I'll talk to constant currency numbers. Sales increased 7.5% in the quarter, reflecting the ongoing recovery and strong execution across our retail portfolio, particularly in Boots UK, where sales advanced 15%. Adjusted operating income was $226 million in the quarter, up 60% versus prior year.
Yeah, I definitely need to try to deck out the Discord. I'll have to make a separate channel for different tickers and stuff. If you guys find research related to companies we've covered or companies you want to cover, feel free to share articles, you know, things like that, graphs, charts, whatever, you know. Feel free to throw things in there. I know it's not really organized like anything right now, and so if there isn't any organization yet, feel free to just kind of go about it. I'll try to get some sort of organization in there when I got time.
Comp retail sales increased 22%, despite the headwind created by the Omicron variant. This reflected strong commercial execution and a recovery from the strict restrictions in the comparable quarter. Market share strengthened across all categories, with beauty performing particularly well. Boots.com sales declined in the quarter as footfall at our physical stores increased 52%. However, the Boots.com business remains in
I'll keep my ear open.
strong position, with sales up 60% compared to the pre-COVID levels. More than 15% of total UK.
Yeah, I don't have a Telegram. I'll have to check it out. I've heard a few other people suggest it.
Proportion of sales originating from our mobile app. Turning next,
I know it's been getting a lot more popular lately.
as mentioned last quarter, our majority investments in Shields and VillageMD closed on October 29th and November 24th, respectively. Segment sales were $527 million in the quarter, with $446 million from VillageMD and $81 million from Shields Health. Walgreens Health AOI was a loss of $77 million in the quarter. All right, and I know I didn't mention it before, but we're actually only going to fiscal year 2015 today, so not going the full 10 years, so it'll be a little bit shorter, which is good because this is actually taking me a little bit longer just to make it through the numbers. Definitely, if you don't do this like every few days, then it eventually becomes a little bit slow looking at these numbers. I can feel myself slower than I was 2 weeks ago, but yeah, so we're only going to go through 2015. I didn't feel like doing the numbers older than that, but that's before Boots was before they combined with Boots, so I kind of considered the numbers a little bit different back then, so I was like, I can argue about just maybe not doing those numbers. Plus there's no R&D to capitalize for this company, so I don't necessarily need the numbers that far back, so we're just gonna work with 7 years worth of data today. Let's now look at some of the key metrics for Walgreens Health. We are on track.
Partially just for those reasons, but also partially just because I was feeling a little bit lazy about it, not gonna lie.
More than 100 Walgreens Health corners, with 47 already up and running. The next wave of 9 locations is scheduled to launch in California.
Taxes.
The rollout of VillageMD continues. With 94 co-located.
Yeah, I don't know if you caught it at the beginning of the stream. I did talk about it a little bit. All that stuff. If you bought into AT&T on the 6th, which was the day that you had to own it to have the shares switch over, you're up on your position today. You're up like 1.5% if you bought it at that point, because AT&T did drop pretty significantly today, but the amount of shares you got more than makes up for it. As of where it currently is, obviously that could change tomorrow, but so far I'm feeling pretty satisfied about that whole change over there. As I was talking about at the start of the stream, though, I'll probably be trimming those positions because I did take on quite a bit extra exposure over the last week or two building into it. I actually made about 25% of my portfolio AT&T over the last week. So yeah, AT&T is actually my biggest position right now, but it's only been my biggest position this week, and it won't be my biggest position a week from now. So, you know, like I said, I had high confidence about what I was doing in this deal. That's what I was talking about the other day when I was talking about the options that I was getting into. I I sold out of the money puts against AT&T, collected the premium, and then had the shares assigned to me because they were out of the money, which lowered my cost basis on AT&T, but it technically means that I was taking on a loss outside of the premium. But if you add in the premium, you add in the dividends, and you add in WBD, then I'm actually up on the position, up about like 2% in a week. And like I said, I considered it basically like a guaranteed profit, so that's why I made it such a huge position, a short-term huge position. But I'm about to unwind that position, so I'll be holding on to AT&T for probably still another while, and I'm not going to be selling out of all of WBD. I'm just going to be selling it back down to the like a normal position size, and then I'm going to hold on to the rest at least until probably like 3 to 6 months. I'll wait for a quarter or two, see what the numbers actually look like as the standalone company and as the company is spun off, because I do think that the market will appreciate the lowered risk on AT&T's end, and I'm not really sure what the market will think about WBD. That's a bit of a crapshoot. So I think WBD has a lot of value for the next 5 years, but it does have a decent amount of debt. So in the short term, it could be very volatile. Yeah, no, it was a fun learning situation for me too. Like, I mean, I had to kind of do a lot of research around it. I obviously put several videos out on the subject, and as AT&T was going down into the deal, it definitely made me look like I wasn't necessarily right to a certain extent, but I feel better about that now that I've seen today go through, because AT&T didn't drop nearly as much as a lot of the bears were saying it would, and WBD is currently trading at a better price than a lot of people thought it would too. So
thank you. As a reminder,
that could change though, because the people who bought on the AT&T end still can't sell out of the shares normally. So more selling pressure could come in the next
thanks very much, and thanks for
week
all
or
the
two.
comments. First, I just wanted to start, James, with your comment that you said the quarter was ahead of your expectations. But when I think about, the next several quarters, were there things that were pulled forward into this quarter? Would be my first question. And how are you thinking? You made a comment about testing. I would assume testing was very strong in January and February, but what have you seen more recently when we think about, your higher revenue due to testing? Is that just because of what you saw in the most recent quarter, or expectations going forward?
Yeah, hi. So no, I made the comment about ahead of expectations, I believe we're maybe 20 cents ahead of consensus, but versus our internal forecast, we were about 8 cents ahead. And where we saw continued buoyancy was on retail, front of store. It's continued,
Whoa, wait a minute.
particularly in the first 2 months of the
Oh, I didn't realize this. I was totally copying this line here.
Testing as
Jesus.
Omicron was peaking. So they were the two items that drove our beat versus our internal forecast, which I said was about 8 cents. We've seen a slowdown, obviously, since then, and maybe I'll pass it over to John Stanley for a couple of comments on what he's seeing currently.
Well, I guess part of the big news there really is just we did start vaccinating the fourth shot yesterday. So what was slowing down has kind of picked up a bit here in the last 24 hours as far as the vaccine goes. I think on the testing, it did slow down, as we came through, the holidays in January into February and now into March. But there has been still a steady business there for, travel and those people still, needing to test. So down quite a bit, but a nice steady stream still ongoing.
Hey, and John, just as a follow-up, we hear pharmacists as a provider, and I know you've been a big proponent of this, and we absolutely agree that throughout the pandemic that the pharmacists have been on the front line. But what does that really mean? Does that change reimbursement? Does it change, their role when we think about them from a healthcare perspective?
Yeah, it's pretty important point, and we did I know Roz was in D.C. a couple days ago. We did get a piece of legislation moving here just in the last week. That's the Equitable Pharmacist Access Bill, and that's really around provider access and our ability to bill under Medicare Part B for services around testing and treating influenza and strep and things like that. And I really think that's a pretty sizable addressable market today. That's honestly largely moved out of primary care physicians anyway and gone into convenient care. But I think it just is a real opportunity in our business to have a really convenient solution. We provide access, obviously, close to 9,000 locations. And I think our pharmacists and our technicians are more than capable, as we've shown, during the pandemic, of delivering these kinds of services. That's a pretty big game changer if we can gain access, to that market and in terms of how we grow our business and in terms of the value we can provide in the communities we serve.
Great. Thank you.
Our next question is from Steven Valiquette with Barclays. Your line is open.
Thanks. Good morning, everyone. So, just regarding the Boots business and the ongoing strategic review of that asset, just a couple of interrelated questions. First, can you remind us where this asset stands at the moment, just on how much the profitability in fiscal 22 is impaired by COVID versus the pre-COVID baselines? And if I missed this, are you able to disclose how much of the international segment operating profit of $226 million this quarter is specifically related to the Boots asset that's under strategic review? Thanks.
Hey, James, I'll turn that one over to you on Boots.
This is the second quarter earnings call for Walgreens-Boots Alliance. We're in the question and answer period with the analysts at this point.
Germany, and Germany doesn't make very much money.
It's mostly just kind of like background while I work, honestly.
Right now, it's only marginally.
I've actually already listened to it once before.
I presume that the majority of the profitability in the international segment is relating to the UK.
Yeah, which if you want to listen to it for yourself, I'm actually listening to it through the YouTube channel Alpha Street. They post a lot of earnings calls to YouTube.
Just the profitability of that segment in fiscal 22. Where's the stand?
Oh, did they?
The profitability on pre-COVID baselines, are we well above?
Very nice.
Are we still below? Or are we kind of in line? Just any rough percentage around that might be helpful just to frame it. Thanks.
No, I think we're still.
Yeah, see, that's another reason I wasn't super concerned about the KBH, my home builder, going down, because I knew that they were in a well-managed position to handle the price going down and perhaps benefit in the long run from it by being able to do some good buybacks. So
first of all, they had a fabulous quarter, given that they had a big spike in Omicron in the quarter, and it's a very foot traffic-driven business, and the traffic shifts really quickly. So look at the quarter they just had, and foot traffic was actually up 52%, but it still remains about 15% below where it was 2 years ago, right? So it hasn't fully recovered. And I think if you cycle back a couple of conference calls, what we said was we expect the Boots UK business to broadly get back to the pre-COVID levels.
yeah, I pretty much can only work with background noise.
Looked at it on a sales basis. It'll be 2023.
I mean, like I know I've said before, I do listen to quite a lot of investing and finance YouTube, and that's like stuff I listen to as background. But I also listen to like lectures, presentations and stuff, college courses, audiobooks, lots of audiobooks. 3030, I think that's kind of in the range that I got my pricing at.
And I don't think there's many retailers in the UK that have a Boots .com business that represents 15% of sales. So this is a business that uses COVID.
So my average price on KBH is 38.
And exit much more strongly than it went into COVID. So this is a business with massive momentum. It's well positioned for the future. Has a large, fast-growing .com business. So we're very happy with it. But as I said, your question is a good one. It won't fully recover until.
Yeah, see, I can't fall asleep to background noise. I know a lot of people who do that, but I can't do that.
The next question is from Elizabeth Anderson.
Macro Voices? I don't think I've ever heard of them. I'll have to
Hi guys, thanks so
put
much
them on
for
the
the
list.
question this morning. In terms of, you talked about sort of reinvesting in the healthcare business when you were talking about the components of the second half EPS numbers. One, could you talk about sort of where those?
Okay, so I got something wrong on that line too. Hold on.
Increased investments are.
What did I do?
And then two.
Oh, something
can you
here.
talk about your sort of where you're seeing labor costs come in versus your expectations? I know that you sort of pointed to that as a driver of SG&A.
There we go.
You know, obviously, it's well known their costs are coming up. I just wanted to understand sort of how that's trending as we move through the fiscal year.
Yeah, I don't think I looked at them yet.
Elizabeth, thanks for the question. I'll start off with Walgreens.
But I'm not sure I necessarily want to add another one, you know, so I might just leave it at the one.
Health perspective, you know, we continue to invest.
But I'll take a look either way. But
made the investments in VillageMD, CareCentrix, and Shields. We're pleased with where we are with those investments, and we're integrating where it makes sense in our healthcare continuum. So that work is ongoing. And we're satisfied in that respect. We did mention when we were at our Investors Day back in October that, you know, we would continue to invest in the business, and we'll continue to do that.
I know you mentioned them,
that, you know, we're seeing,
but I just didn't get a
really
chance to look at them.
Performance, particularly in our specialty pharmacy area with Shields, and so that would be ongoing. I'm going to ask James to talk with any further detail on Walgreens Health with the investments. And then, John, if you could take it from there.
Yeah, just quickly, Elizabeth, you know, basically what we said is while we maintain guidance, we took up guidance on the base business, and we increased the investment.
We'll just leave it on there.
On healthcare.
Wasn't sure if I wanted to count Amherst-Bergen as an acquisition, their equity investment in, but I guess I will, whatever. I mean, like I said, I'll take a look at it. I'm not opposed to having two in the same industry. It's just, like I said, I am aware that it's a little bit tricky. And it's like, if I bought them at the same time and they both remain small, it'd be one thing, but KBH is already a sizable position, you know? So, I don't know. I'll take a look. A good company is a good company. So, if it's like, you know, if I actually think it's that much better, then, you know, I'll go for it. But
in the last conference call, we raised the guidance for the full year from 160 clinics in the calendar year to 200. And now we're just aligning a bit the expenses and the phasing of those rollouts. So probably is a longer term positive, and we're just readjusting expenses in the short term. The other thing is we're really doubling down on the organic investments to meet the requirements of Blue Shield California and Clover. We're making strong progress against both of those. So call it a reinforcement of expenses exiting the year, because, you know, we're resolute here. We want to exit the year stronger than when we entered. So this is all about investing in the future growth of the company. And John, maybe I'll pass it over to you on the labor question.
Yeah, I think I just make a couple of comments. One, I'm really excited about the investments, you know, that we're making in the Walgreens business. We're really deep into our micro fulfillment strategy and rollout. And, you know, as we've talked about previously, this is really a program we're rolling out to support our pharmacists and get, you know, work out of our store and free up team member time to really provide additional services in the pharmacy. So I'm really excited about that investment and the progress that we're making there. And, you know, we touched on with Lisa earlier about, you know, some of the potential value drivers there. I think there's just a lot of upside there for us in the future. So super excited about that. And there's other investments that we're making in the business in addition to that, you know, around pharmacy with automation in our call centers and things like that to improve the experience and take, you know, other work out of the stores and out of the pharmacy. On the labor side, you know, as we talked about over several quarters, we have made some really significant investments here. We raised our starting wage across the company to $13 last fall, and we moved up to $15 in the fall of 23.
All right. One more year to go, guys.
And we have also made changes to our tech starting wages, went to 15 in the fall into 16.50 this coming fall. And I think we talked about about where we were with some investments. Last quarter, we had about $120 million of investments that we'd made for wage premiums in hard-to-staff areas with pharmacists, as well as recognition bonuses that we paid to really recognize our team members for really the hard work and dedication that they've shown here through the pandemic. And I think as we look forward on where we are versus our expectations related to all of that, I think we included in our updated guidance here about $40 million of additional expense in the back half of the year, so pretty close to what we expected.
Got it. Thank you.
Our next question is from A.J. Rice with Credit Suisse. Your line is open.
Hi, everybody. Thanks for the question. I wondered, obviously, you're rolling out at a nice pace both the health centers, the Walgreens health centers,
cash
as well
flow
as the
statement.
WBA, and you've got a number of them that are co-located. I wonder if you
Options.
could, if it's possible to start to talk or provide a little more information on how that is impacting the retail operations, or can you point to increased script volume or increased foot traffic in the front end that you can attribute to either the co-located Village MD or the health centers?
I said I listen to a lot of podcasts, but I don't necessarily listen to a lot of finance podcasts. I listen to a lot of finance YouTube. Demoteron, yeah, I watch everything Demoteron. His lectures. If you want to learn to do what I'm doing, go watch Demoteron's lectures over and over and over again, because that's what I did to learn how to do this. I'm in college as well, but I learned how to do it before I went to college by doing that. But the Rational Reminder podcast, that's a really good finance podcast. They're a little bit more efficient market kind of guys, but they go through data a lot, really good data. They talk about like real papers. They're like guys who actually understand how to like read papers and understand statistics and stuff like that. So if you want a really good finance podcast, Rational Reminder podcast, which is on YouTube. You don't have to get just the podcast version.
The other thing I will tell you is, as we see these expand across the U.S., I will tell you, after having walked several of them and watched the patient feedback.
Yeah, Demoteron is king.
Comforting to see.
Easily the best source on the internet for learning investing. Not even close.
Because they are much more engaged with.
Like there's nobody that's even close to as good as Demoteron for learning to invest.
Just inside the building.
Which is funny because he's not even like a great investor, so like in general, the rule of thumb is in general to only take investing advice from people who've made a lot of money, which by the way means I guess none of you guys should be taking advice from me because I haven't made that much money investing. But in general, you want to look at the best, right? But Demoteron is just good. Fast Graphs, the name sounds familiar, but it's not coming to mind. I'm not sure I know what that is.
Older practices where a pharmacist and a doctor together.
Yeah, Demoteron's the best.
Deliver lower medical costs than just a primary care physician by themselves. So the other big hypothesis that has to play out in the co-located stores is the combined effort of a pharmacist together with a primary care physician in managing down the cost of healthcare over time. And as I said, they have strong evidence on their standalone clinics, and that will translate over time to improved health performance on the clinics they've co-located with us. So there's a bunch of KPIs we're watching very, very closely. But, bear in mind, it takes 2 years for a clinic to get up to a kind of a reasonable level of operations. So
Fast Graphs, Investing Grandpa. Yeah, I don't think I know either of them. But there's a lot of people out there, so.
Will be in great territory over the coming year or two.
Okay, thanks a lot. That was very interesting.
Maybe I'll have to check them out.
The next question is from Charles Fragey with Cowen.
Yeah, because I do also listen to lots of podcasts of all sorts of other topics as well. So I listen to a lot of stuff related to economics and politics as well. So it's not always investing all the time. Plus, I have to listen to earnings calls too.
Can you kind of give a sense of what type of folks you're speaking with, and
kind of characterize, where you are in those discussions and perhaps how close you might be to signing some?
Whoa. I screwed something up here.
Well, Dave, thanks for that question. So
Goodwill.
we had committed that we would have 5 significant
Intangible. 19.
by the end of
There's
the
something
year,
here.
and I will tell you that we have 2 of those, one in Blue Shield of California, and then the other one with Clover. There's a third one that we've just recently signed and will be announcing shortly here. So we feel like we're on a really good.
Yeah, I did watch that video.
How we are
definitely looks interesting.
These entities and moving them forward. The other significant piece is that we are adding health corners out in California to support the current relationships with Blue Shield of California and also with Clover. So we've got more of the health corners coming on, and just as a reminder, those health corners, they are becoming the health advisors in the community and provide something on top of, when you think about the work we're doing with Village MD. So we are encouraged and really aggressive in developing these relationships, and we have a commercial team that is working alongside to make sure that these come online, and then we do the work that we need to do to bring the health corners up to speed to support them. So we'll hit the 5 contracts that we talked about at the beginning of the year.
Great, appreciate that. And just to follow up, if we think about the work you're doing with health corners, the partnership with Blue Shield, Village MD, clearly we saw with COVID testing, a real rise in people doing at-home testing. Have you thought about, the role of at-home diagnostics has and how that would fit within sort of the Walgreens Health business that you're building?
Yes, we learned a lot during the COVID testing process, and I think we talked earlier about the work we're doing with LabCorp to provide at-home COVID tests. So, it's giving us
All right.
A real bright light into what more we can do in this space. I know that John Stanley.
All right, we'll go ahead and pause that there. Finally done with the 7 years that we're going to do. Took a while to get here. Very appreciate you all sticking around. Obviously, we got some of our usual regulars, and yeah, it's pretty awesome that you guys come around so regularly. I love it. I love you guys. Thanks for making it feel like I'm actually doing something worthwhile putting the camera on. I don't have to turn the camera on. I can just do this alone in my room by myself. If you're watching and you haven't already liked it, it would be really appreciated if you could like it. Starting here at the bottom, as we usually do with sales to capital ratio, you can see pretty stable over time. It's jumped up into kind of the mid 3s over here and dipped down to the 2s. Pretty high sales to capital ratio. As I was saying, retail usually has very high sales to capital ratios. They usually have low margins and high sales to capital ratios. It's pretty typical for most of retail. So that's just the typical way it is. Whether or not we think it's going to move back up or move back down is a real big question. Definitely been looking at Starbucks. I've definitely been watching that, GT. I'm definitely not super enthusiastic. I was kind of very curious to look into it when they were like talking about their share buyback program and it had dropped so much, and then now Howard Schultz has come back and is taking away the buyback program to focus on employees and stuff and the unionizing. That all looks like a big mess to me, honestly. I'm not gonna lie. Like at first I was like, you know what? At first it was like, this looks like an opportunity to get into Starbucks, but I don't know. And it's not even necessarily about the buybacks, but the very union focused mindset. Like it's very defensive. It doesn't mean it's the wrong thing to do as a business. Like it might be the smart thing to do, just to defend your space by making sure you don't lose all your employees or something. So it might be still good for the business overall, but it's still a very defensive type action. And I don't know. It's still, maybe if it keeps going down, we'll probably get pulled to it eventually. But anyway, so yeah, looking at these 2s, 3s, it's very stable over time. We'll probably go ahead and use our 5-year average as kind of like a baseline number, 2.6. It's a little bit higher than our most recent years. So you could argue that these most recent years are being weighed down by some of the extra investments in Village MD. Unfortunately, those investments are expected to kind of continue moving forward. So maybe it actually does make more sense to use maybe a more recent year average. The 3-year average comes down to 2.6 versus that. We could maybe actually just use even the most recent year, which kind of I think actually probably would make a little bit more sense, just because again they have the extra investments that they're expected to do with Village MD moving forward. We're not going to do a very complex revenue model or anything for them. We are going to do basically just a top-down, relatively simple single-digit revenue thing. So just so everybody knows, we're not going to be doing anything super complex for that. It is a very mature business, but because of that means we do want to make sure that the sales to capital numbers and the margin numbers are relatively accurate, because we're kind of just going to be having a wide spread as far as the revenues go. Taking a look at the balance sheet, you can see that over this 7-year period, the liabilities and equity has come up pretty significantly, while the shareholders' equity has actually come down. That's pretty interesting to see. It is partially on the back of a huge amount of share buybacks. You can see that here they've done 20 billion share buybacks when they only had 4 billion on the balance sheet prior to that. So a huge amount of share buybacks over the 7-year period, which is part of the reason that the equity has moved downward. Overall, the retained earnings has moved upward pretty significantly. It's come up about 10,000 during that period versus the 16,000 there. So you can say that the actual shareholders' equity was eaten into about 6 billion over the period. Considering that there was some peak prices, what was it, 2018 through 2016 kind of time frame, that maybe wasn't necessarily the greatest idea, but it does kind of depend on where those share buybacks are being weighed in the most. If we look at the pressure, actually it does look like they were maybe doing a lot of share buybacks at actually like the least opportune time. Doesn't mean it was actually a bad time. It could still have been undervalued, but it looks like it was the least opportune time, relatively speaking. So it's not necessarily the greatest thing. And we take a look at their current liabilities, that's exploded from 16.5 billion to 22 billion versus their current assets of 19.6 billion to 15.8 billion. So their current assets have come down while their current liabilities have come up. That's definitely very worrying to see. They have obviously great credit in terms of like handling their vendors and operators, because they have a great position in the market, well-known and very well-established, mature brand. But definitely that's not a deficit that's not very appealing to look at. 15.8, what is the actual deficit? So it's like 6 billion or so, kind of missing from their acid test ratio. And then on top of that, they still have the 29.8 billion. So 29.8 billion on top of all that, yeah, their balance sheet's definitely not very pretty. The actual debt to equity ratio, I'm pretty sure, is like in the 80 or 90% range or something. We'll see what it looks like when we scroll over. Return on invested capital, they were in the solid second digits, low second digits, but solid second digits in the past. And then in these most recent years, it's definitely been much lower as well. Again, they've taken on the extra capital base to as part of their newer investments. So the argument is, well, they're going to be able to push it back up over time. Maybe that's the case, maybe not. It definitely isn't looking super pretty. Let's look at how they've actually paid out to their shareholders over the 7-year period. A total of 27.7 billion or so has been paid out, or no, that's what they could have paid out to their shareholders. The total amount that they did pay out to their shareholders was 28.6 billion. So they did overpay their shareholders a little bit, not a crazy amount. And as I said, you could argue that it was kind of being the heft of it came in these 2 years of $5 billion net treasury purchases each. So yeah, some pretty solid weight to be had there. But again, those are also the years where they had relatively high prices. 65.8 is the price that it ended fiscal year 2018, and 81 is the price 2017 ended. So they were doing the most share buybacks at the highest prices. Not very good. Not very good at all. Again, if the value is actually above that line, well, then it's not actually bad, but that's a pretty high line to have to hit. So that's not very good at all. Looking at the margin, as we were saying before, pretty low margins in the most recent year, but also pretty low margins generally. Definitely looks like it had a little bit more solid of single-digit margins in these previous years back here. In these most recent years, it's definitely been especially low. We probably will run off of this 3-year average, I guess, as a pretty solid number. I guess that makes the most sense to use as our baseline. So with that, we can kind of scroll over and start making some assumptions. Don't pay attention to this. We definitely have a lot of things to do. In fact, I know exactly where it's coming from. It's coming from this 5 to 15% spread of margin. So obviously you can just assume right off the bat that is very, very not accurate at all. So we're just going to go ahead and lower this so that we're not looking at something completely misleading right off the bat. Now, obviously, this is still perhaps misleading too, so don't necessarily decide that that's where we're going to go with it. We're going to come back to the margin after we look at other things too. But I typically like to start with the debt to equity ratio, so we'll start with the debt to equity ratio. So there it is, 81%, about where I was assuming it would be. Weighted average cost of capital comes to 6.37%, with the cost of equity being 11.77%. So pretty decent cost of capital. It's not too bad at all. However, the returns on invested capital that they had in the most 3 years recent on average puts them just over it, the excess returns being just barely positive. So that's about where you expect mature companies generally to be, but definitely not super exciting. Hey man, we still got to put other things in, so we'll see where it ends up. Like the sales to capital ratio is way too low, for example. Sales to capital ratio, we're going to use kind of this measure here as a baseline. I'm going to put a pretty general spread of maybe like 1.5 to 3. Let's see, what does that make our baseline? 2.25, yeah, 2.25. That's a little bit lower than the current level. See, that improved the price pretty significantly, so we did have to adjust for that. So as I was saying, it's like don't give up on it entirely too yet. We'll see where we go with it. So that gives us an expected range of sales capital ratio of 2.46, which would assume that maybe they do improve from the most recent year, but still perhaps a little bit lower than they had been in the past due to the Village MD investments. It's a pretty satisfying number. I can be pretty happy with that. So let's come up to the revenues. The current revenues range that we have is -5% to 10%. I do think that's probably way too wide of a range for them. Maybe -3% to 5 or 6% or something like that. I'm definitely projecting pretty low single digits. If we come over to their earnings presentation, they themselves give us, where's the guidance in here? It's a little bit further down. The guidance here for they tell us, actually they show us the record of their guidance, which is kind of interesting to show the change of the guidance. The guidance that they gave at fiscal year October, which is based on the numbers we're looking at, they gave 4% for fiscal 22, and then January they said fiscal 22 was going to be 5 to 7%, and now it's 6 to 8%. So they've been improving their guidance over the last 3 quarters. It's worth noting, but I do think that has to do partially with the expectations of future shots on this particular year, and then the market in general is assuming that there's going to be less of that moving forward. In fact, let's go ahead and pull open the Yahoo analysis page. So the market is expecting revenues to be flat this year, relatively speaking, slightly down, and then maybe back to 2.4% growth in the year after that. An average of 135 billion revenues in 23 is what the market is sort of seeing. So, I mean, I myself see the revenues that they are guiding for this year probably coming through, and then I could see there being a revenue drop in 23 perhaps, or in 24, as some of those excess COVID revenues start to dissipate, but that'll also be picked up by the low single digit growth of the Village MD stuff, which on net, I'm basically going to assume that it's probably going to be, yeah, low single digits for the 5-year period, 1 to 2%. That pretty much nails about what I would expect. Again, the analyst average number for 23 was 135 billion or so, in fact, slightly lower than it. So I'm actually a little bit higher than them on this particular number right here. This number, oh, well, let's actually lower this maybe be between this range right here, which brings expected value to 1.22. Yeah, so okay, I'm pretty satisfied with these revenues. Not a major spread. Now, let's see, do I want to change the probability? Probably willing to lean a little bit less into the negative for them. If for no other reason, then these are nominal term revenues, and I do think inflation is going to at least be higher than the 2% expected number for the next several years. I don't know how much higher is a big debate, but solidly higher. So on the basis that these are nominal numbers and therefore has to be adjusted for inflation, that alone means that I'm going to lean into the more negative numbers significantly less and put more probability into the higher numbers, just on the basis that these, not that they're making real profits, but actually having inflated numbers due to nominal changeovers in costs. So that's just one way of thinking about it. That kind of pushes the balance of it to about 1.5%. Maybe pretty satisfied there. So let's come back down to the margin and we'll think about this. Now, as far as our worst case scenario, we're actually going to make the margin as low as we can possibly make it, because it's so close to 0 anyway, but I can't put an actual 0 in there, but it needs to be something that makes this number a non-zero number, because it has to be an actual model of a state of a company that is actually still existing, so that I can do the chance for default appropriately on that. So we'll use 0.5%, I guess, as the lowest base for that particular line right there. And then for our top revenue expectation, probably not 5, well, maybe 5%, I don't know, 4%, 5%. How much higher do you necessarily want to put it? This is the argument. Like I said, we're looking at low revenues for the last 3 years with a little bit of higher revenues for the 4 years prior to that. And the argument is, do we think that they'll go back to this kind of 3% range? Or do we think that they will stay in this 1% range? Or do we think that they will manage to have the average of that overall, which was 2.87%? So maybe 2.75 2.5 is maybe pretty fair. We can maybe put this one down to 2% to kind of lean a little bit further down. Puts it to 2.88%. I don't know, maybe this to 2.5. This is definitely where the whole valuation comes to, because this makes the biggest difference. It's like if the mid-level revenues or the mid-level margins come up pretty significantly, it becomes a pretty good valuation. I mean, not an amazing valuation, but at least becomes fair value. So this is definitely where the where it breaks down. I mean, I guess I could leave 5% as the, well, maybe not. I guess 4% might be the best upper bound, but then maybe I could shift the probabilities backward a little bit, because I did kind of lean into the more optimistic end of it a bit more off of the sales figures. But maybe if I push it 5% back into the medium case, brings the expected revenue CAGR to 1.41 and the expected margin to 2.43. So that gives them room to increase by 0.5%, a little bit lower than the 2019 number, but still lower than the previous numbers behind that. And maybe give them a slightly more optimistic case on the analyst model. I mean, what do we need them for? To convince them to all buy Walgreens? I mean, maybe. It won't change the value. Unless they can, of course, you know, issue a whole bunch of shares at some really high price or something. I don't know. Okay, so anything else I want to shift before moving on to default risk? Might be satisfied there. Tax rate about 18%. Okay with that. Maybe the problem with that is that it requires an ever greater number of people to be behind you. You know, for every time that the crowd comes after you, you will also come after the crowd. Unfortunately. I mean, statistically speaking, obviously, you can become an expert at picking the right moments and the right stocks before they move and stuff like that. But I don't know. I don't think Wall Street Bets is going to help Walgreens. I have more faith on them being able to help something like Corsair or something that's already got a significant amount of shorting going on in it. But even then, you know, it's not the same situation as like GameStop. So okay, let's do the default adjustment, and then we can basically call it. Looking at their perpetual debt levels, 17.8. And 1.07. Oh, nice. 100 messages. And maybe. Does Wall Street Bets talk about VVV? I don't know if I've ever heard them talk about that one, but that would be a pretty decent choice. Oh, whoops. Unlock. Button there. Here. Okay, so we lowered the default risk a little bit for them. All right. So, all right, pretty much done with ticker here. WBA, Walgreens-Boots Alliance. So the U.S. Treasury selling for around 2.77%. Mature market equity risk premium of 4.87% currently. I get to a discount rate for Walgreens of 11.77% after adjusting for debt and company specific risks. They have a dividend rate of 4.23% currently. 5 years ago, they had sales of $117.3 billion against the sales in the most recent year of $132.5 billion, which comes out to 2.46% sales growth per year for the last 5 years. Sales capital ratio of 2.35, which was actually the most recent year figure, if I remember what we did. And the industrial expectation is about 5.13, though it is a little bit weighed down by smaller health support service companies and that, so it's not entirely a super accurate measure using the industry numbers for this particular valuation. Returns on invested capital in the 3 years most recent on average is 6.51%. Debt to equity ratio of about 81% currently, and default risk in the most recent year of around 1%. Profit margins in the most three years on average has been 1.72% against the industry of the most recent year average of 5.69%. So pretty low in sales capital ratio and margins on a relative basis, though the sales capital ratio is pretty high on an absolute basis. Profit in the most recent year of 2542, 2.5 billion or so. We have them currently selling for $44.43. So the probability distribution that we use is pretty decently tilted into the fourth model, with a lot of the weight still being solidly in the median case model. That gets us a revenue projection of anywhere from 113.7 billion in the worst case scenario to 169.1 billion in the best case scenario, which is a -3% to 5% range per year for the next 5 years. And that gets an expected value of 142 billion, which is 1.4% per year for the next 5 years. Our sales capital ratio, we have 2.4 expected basis, and our return on invested capital of 6.02. Debt to equity ratio. Oh, wait a minute. Oh, getting ahead of myself. I totally forgot to change the debt to equity ratio. Oh, holy crap. Getting totally ahead of myself there. Maybe Walgreens isn't dead yet. Let's find out. But yeah, those margins, man, pretty terrible. And I mean, again, as I was trying to show, it's like maybe I'm being too pessimistic on the margins. If you push this this top range up to 6, which brings the median case to like 3.25 or whatever, then it puts it a little bit undervalued as it's currently basis here. But actually, hold on a second. Like I said, I totally forgot to adjust the expected debt to equity ratios. So let me think about that real quick. I totally got ahead of myself there. Let's see, assume maybe 26 billion, which would be about a third if they took on more debt. So that we could easily see this maybe going to like well over 100, 130. Let's see, on the best case scenario, definitely not 0, maybe like half as much or something. I do have a decent amount of some retail stuff in that list that I put together, a few interesting ones. So our expected value comes to 73%, currently 81. Also, let's change this. Maybe change this up to 90. Let's see, that puts it to 83. Okay, yeah. So that really didn't change too much. In fact, that made it a little bit worse. But okay, yeah, but that means I do need to change a bunch of things. Hold on. That also means the default risks changed. I totally got ahead of myself there. Completely forgot that one. I mean, like I said, I normally start with it at the bottom. I'm not sure. I know I went down there at the start, but then I got distracted by something somebody said or something. I did think that their default risk was kind of low. That kind of explains that a little bit. All right. Yeah, I'm not entirely sure what automatic settings it has. I can't remember what things I may or may not have set it on, so I don't know what happens to people's chats if they say the wrong things too much. But oh yeah, I see it went away. Yeah. Anyway, so I'm gonna have to start over though, because I do like to have the link on the end there. So ticker WBA, Walgreens-Boots Alliance, Treasury 2.77%, equity risk premium of 4.87%, discount rate 11.77%, dividend 4.23%. Our probability distribution have somewhat tilted into the optimistic end fourth model. $442 billion expected revenues, which is 1.4% expected value per year for the next 5 years. We have sales to capital ratio of anywhere from 1.5 to 3, which on an expected basis comes to 2.4. Returns on invested capital are about 6.2% on an expected basis, and our debt to equity ratio is a range of anywhere from 40% to 130%, and we have an expected basis about 83%. The default risk on that debt is a little over 1% per year, 1.36, which is a little bit more than generally like to see, but nothing too drastic either. Profit margins, we have a range of anywhere from 0.5% to 4% on the high end, which gets us an expected value of 2.51%. Profit that comes out of that is anywhere from about $500 million to possibly $6.7 billion on the high end. We have $3.5 billion as an expected number 5 years out. That gets us a present value of $30.85 per share, which is 30% lower than the current share price. We have 5-year forward value targets, not counting the dividends that they would pay out during the period. So you would have to subtract out dividends from this number to get the price of anywhere from worst case scenario $11.08 to best case scenario $116.67. On an expected basis, we see $53.82. So based off of that and the current price it's selling at of $44.43, we get an expected return for the next 5 years of 3.91%. So yeah, definitely not super pretty, and it does have quite a lot to do with these margins. If we, like I said, if you could guarantee that the margin would be 3%, this improves pretty significantly. Like just look right here, 3%. Look at the fourth model. Just look at the fourth model alone. 3% sales growth, 2.63, which is not too much higher than they currently are in the sales capital ratio. 62%, so that assumes that they pay down some of their debt, and a 3% profit margin, and then it would be worth $42.52 today. So it would be about fair value, and then that would get you a expected return of 10 to 11% for the next 5 years. But that's also on the assumption that they pay down a decent amount of their debt in that model. It's worth noting. So actually, even if they kept the debt to equity ratio around 81% on this fourth model, if that was the only thing that was different on it, it might be closer to 45. It might be 44, 45. It might actually be fair value under that circumstance. So yeah, it really is the margins. The margins is definitely the thing that's keeping it down. No, this little section right here, it doesn't currently have anything there. It was I used to have some formulas in here to scrape the information from websites and bring it in, but then those things stopped working and I kind of just started ignoring it. So that's sort of the way it is. Oh, that is worth knowing. I forgot what I was gonna say. This is from the number 6 months ago. So if you actually apply the discount rate for the current amount of time that's passed since that 10K came out, then actually this becomes the more recent spread of numbers. So it's actually closer to 33%. This should be red. I don't know why that's not coming in red, but so it's actually closer to $33, not 31. So there's been a little bit of an increase in value due to just the time that's elapsed, essentially. So it's a little bit of a different, but like I said, I was kind of lazy and didn't feel like doing the most recent 12-month numbers because it wasn't going to change it that much. But yeah, so I'm definitely not super great looking. Just comes down to those margins, and again, I could totally be wrong on those margins. If that could change it, but it also doesn't change it into a great investment, right? It just changes it into an okay investment. It's like if we do that, it turns these median cases into okay options. It doesn't make it a great investment no matter what. Like there's pretty much no way to really do that because those margins are not going to be sustained super long term. Yeah, hard pass. I concur. So that's gonna do it for us today. Thanks for the super exciting chat that we've had going on and stuff. Quick check on NRG. We'll do the quick check on our NRG. Let's go take a look. All right, well, look at the analysis right off the bat. Apparently, they're expected to have a drop 26% in revenues this year. Are they spinning something off or something? That's usually what that kind of means. They're like spinning something off. Energy. What a great name. NRG Energy. Together with its subsidiaries, operates as integrated power company in the United States, operates through Texas in East-West, producing, selling, delivering electricity, 6 million residential, commercial, industrial, natural gas, coal, oil, solar, nuclear, and battery storage. I do like nuclear power. I'm a big fan of that. Let's see, on-site energy solutions, in trades, electric power, yada 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 yada. Okay, so nothing particularly outstanding. It's just typical utility stuff. Trailing PE of 4. But again, expected revenue drops of like 20 to 30% over the next 2 years. Like I said, I'm assuming they're selling a chunk of their business to somebody else. That's usually what happens in utility companies. They do trade things back and forth a lot. 5% shorted right now. Nothing too crazy on that. This is a pretty decent return on assets for a utility, if that's anywhere reasonably close to accurate. They're usually only single digits, so that's not bad. Let's see, forward dividend yield 3.5%, market cap $9 billion. Okay, so let's take a look at the financials. 26.9 billion, 2.1 billion kept, so less than 10%, but more than 5%. So not terrible margins, but definitely not great. Pretty typical for utilities. Operating cash flows, significantly lower cash flows in the most recent year compared to their income, but a little bit better in the years previously. Pretty high capital expenditures in this year. Not super great, but I mean, that's part of the business a lot of times. If they're spinning something off in the next year, then I assume they'll be getting a lot of cash back next year as well. I'm not sure. Like I said, I'd have to look into finding out why those revenues are expected to decline so much. Like I said, I assume they're spinning something off, but that's a big assumption. Only 250 million in cash on hand. That's not super great. So 19.25, add on the debt. We end up with 27, 28 or so. What was there? It was 26. Okay, so not a great one as far as the sales capital ratio goes. Yeah, I'd say it's definitely not super appealing to me just off of the first glance. Oh, I wonder if Joel Greenblatt's talking about this one or not. Debt management aid. Yeah, retail is pretty rough with those margins. It's the key to retail is finding some company that has a niche that like nobody else has. That's the only way to get good margins. Which is why, like I said, when we were doing those screenings, Build-A-Bear Workshop was coming up. I'm pretty interested in actually doing a deep dive on that one. That one actually sounds pretty interesting. It's retail, but it's a little bit experiential. You know, it's like nobody else does exactly Build-A-Bear. It's like maybe you make bears, but you don't have the workshop, right? So their margins were a little bit better, and I think that one might be a decent one to take a look at. But anyway, all right, so that's gonna be it for today, guys. Much appreciated. Thank you for all the likes. Thank you for all the chat. I'm not sure what we are going to be doing on Friday. Maybe it will be Build-A-Bear Workshop. I'm not entirely sure. I also was looking at Invesco, so maybe it'll be Invesco, maybe it'll be Build-A-Bear. But either way, we'll probably cover both of those in the very near future. So if anybody's watching this on the repeat and has enjoyed this content, I know everybody in the chat basically has already liked it, but if you're watching a repeat and you haven't already liked it, please do like it. We are constantly trying to grow this channel. We've been doing really good and getting lots of views and lots of subscribers. I appreciate you all.